Why every trader must have a business plan. This is what we are going to discuss today in the first episode of our brand new series, How to Become a Successful Trader. So let's get into the details. Why every trader must have a business plan? Simple. A trading plan is a trader's business plan. Putting together a proper plan will force the trader to focus on his strengths while letting him avoid conditions that are unfavorable. Very few businesses succeed without a business plan. So why should a trader think he is above it? Trading is a business and don't ever forget it or take it less than that. Business plans are made either before going into the business or when trying to raise more capital in the business. This should hold true as well for the traders. Before you get serious about full-time trading, you should take some time and put together your business plan. Basically, it should include objective, strategy, risk, costs, and expected returns. You should first document and you should do it before you risk a dime. Before you transfer your money from your bank account to your trading account, you should have a detailed plan of what you are going to do, how you plan to do it, how much is at risk, and what are the chances of losing this money. This plan is the most important thing because it is your hard-earned money on the line when you are trading. So let's discuss in detail about the importance of the business plan and how to create one in this episode. This is the first and foremost step every aspiring trader should take before they start trading. Most of the new traders end up losing money as they skip this most critical part. So how to make business plan for trading? We can simply call this as trading plan. Trading is like any other business and doing a business without a proper business plan will end in disaster. So hopefully by now you understand the importance of the trading plan, that is a business plan for trading. So it's time to start making one. Though a proper trading plan can have anything you feel should go into it, it should account for the listed parameters mandatorily. They are what to trade, trading time frames, conditions for entering a trade, condition for exiting a trade, condition for stop loss placement, positional sizing, money management, risk reward ratio, backtesting, and periodic performance review. Each one of these things is a critical part of trading, but when combined, they become an invaluable and powerful trading tool. Other things that are not so easy to pinpoint but should be taken into account are your emotional state and your trading style. Each trader will have a unique trading style and risk style, which is why it is impossible to have a fixed trading plan that anyone can use. If a trading plan doesn't fit your trading style and thoughts, you will have trouble following it no matter how good it is. This is why each trader should build their own custom trading plan. So we won't give you a trading plan directly, but will guide you to create one that fits your trading style and risk tolerance. People think having a strategy is enough to trade, but trading strategy is only a part of trading plan. Without money management, positional sizing and backtesting, any strategy is useless. As you start making a more elaborate and professional looking trading plan, you should go back to the idea of doing a business. First step is convincing yourself to invest in some business. If that's the case, you would want to know some basics about the business, like what kind of returns are reasonable to expect. Does this include all the costs? How much you can lose at the worst? Are there any unexpected variables that can wipe out your business? These are general questions anyone would ask before getting into any business. Likewise, you should ask similar questions for your trading business. So when it comes to your trading plan, it should cover which markets or stocks or sectors you will trade, what will be your holding period, where would you enter and exit, how will you use your stop loss, did you backtest this system, and so on. You will also want to have proper money management plan which will tell you how much you will risk at once, how you will prevent yourself from losing all the money, how many positions you will be trading at the max at any point in time, and so on. If you can answer all these questions, you will be much better trader than someone who can't. So when making a business plan for trading, we need to have all this information. Now, let's create a trading plan. First part of creating a trading plan is to create a trading system or a trading strategy you will use to trade with. A trading system or a strategy is basically a set of rules and conditions that will give you signals to get in and get out of the market. A signal in a strategy can simply be like buy a stock at opening today if it had hit the upper circuit yesterday. Or it could be a complicated strategy using several indicators and then make a decision based on them in combination. It doesn't matter what type of strategy it is as long as you are consistent and have rules to follow. Also, regardless of what type of strategy it is, make sure you backtest the strategy over historical data. The main drawback of complex strategy is that it's much harder to backtest it. You can also test it in the live market and learn the hard way whether your strategy works by losing money in the market. It is totally your call. I prefer backtesting even if it is manual backtesting by simply using a bar replay option. You want to make sure your ideas have a history of working because if they didn't work in the past, they probably won't work in the future. By having a system or strategy, you will know how and what you will trade. Nothing should come as a surprise, and you will reduce the number of bad trades you make. I'm certain you will still make lots of bad trades, but you will probably make lot less by following a trading strategy. Bad trades are different from losing trades. Many good trades will not work out and you may lose money on them. However, bad trades are stupid mistakes that a system or strategy can prevent. With a strategy in place, you will know that if a certain condition is met, you will get in and get out of the market. However, no matter how bored you are or how much extra margin you have, if these conditions or criteria are not met, you shouldn't do anything. Moving on to the next part of trading plan, which is getting out. One thing I need to stress is that entering a trade is only half a trade. You need to get out of them as well. Too many people come up with great buy signals, but they forget that they have to exit a trade. Like getting you into a trade, a system must have rules for getting you out of the trade as well. Don't ignore this part of trading. The exit really is the difference between what makes a winning or a losing trade. A good system will have options for getting you out of a winning, break even, or losing trades. I would say that before you even enter a trade, you should know where you will be getting out, both with a winning and a losing trade. So, what is the most important reason for having an exit strategy? Reason is simple. Once you are in a trade, having a predetermined exit rule will help you to relax during the trading and you do not have to look at the market tick by tick. Moving on to the next important part of trading plan, which is money management. Though a trading system is important, money management and risk parameters are even more important part of trading plan than the actual buy and sell signals. You need to know how much to risk, how many contracts or shares to trade, when to increase or decrease positional size, and which stocks or markets you can afford to trade. A money management plan will tell you how many trades you can have at the same time and how much you should risk in each and every trade and in total. Knowing how to use the proper positional sizing is a large part of money management and the most important factor of your trading success. Risking more than you can afford to lose can easily get you into trouble even if you are on the right side of the trade. If you trade above your risk potential, you may not be able to hold the position when there is a little blip against you. So even though you were correct in the direction of the trade, you may end up exiting with a loser. If you work on a good risk plan, you will reduce the chances of blowing your account. I know that any time I took a really big hit, it wasn't because I was wrong. Yes, obviously I was wrong, but the reason I got a big loss was I used a poor money management and traded too large a position or allowed myself to risk too much on a single trade. So do yourself a favor and take time before you trade to come up with a good risk or money management plan. Moving on to the most important aspect, which is trading mentality. When making a trading plan, you should figure out which stocks, sectors, or commodities you will trade. Stocks move differently from each other. Some trend more often, while others are choppier. Some are wilder than others with wider ranges, and therefore you have to trade less size and use wider stops. People have preferences for some stocks over the others, and this is all part of their trading mentality. Your trading plan should be tailored to the stocks or commodities you will be looking to trade. For some people, it is fairly easy. They just take the indices. Others may trade commodities like crude, while some others may include any stock with huge volumes. It is not important what you plan on trading. Just know it in advance so that during market hours you can focus on trading and not have to worry about finding stocks. This is exactly what we do in the Market Secrets Telegram channel as well. Even before the market opens, we know what stocks we are going to trade and which index we are going to trade. We even know which levels we'll be trading. This reduces the number of decisions that we take during market hours. Another part of trading mentality is determining your trading time frames when you are making a system. Some people can hold a stock for weeks while others get fidgety after few seconds. The shorter the term you hold, the more you will trade and smaller your stop loss and targets will be. Personally, I can't follow a system that needs holding a stock for a few months. I prefer holding for a maximum of few days to a couple of weeks, so I have a larger targets and wider stop loss. When it comes to intraday trades, I prefer very quick targets with tight stop loss and small targets. Again, everyone is different, and this difference should be incorporated into your trading plan. Moving on to the next part of a trading plan, which is backtesting. If you want to succeed in trading, take the time to make sure your ideas work. Backtesting your system is so critical it cannot be overstated. Though there are softwares like AmiBroker that will help you to do it with the simple scripts, if you're not good at programming, you can take a chart and do it manually by going through it directly or using a bar replay feature which will help you to simulate the market conditions. When you do backtest, keep a track of trading cost. Do not make the stupid mistake of backtesting a system and forgetting to include how much brokerage, taxes, slippages, exchange fees, and so forth that will be taken out of your account. Make sure these are all accounted for or you will be in for a surprise. So coming to the takeaways from this episode, the main reason for lack of trading plan is that they can be time consuming and difficult to make. Most people want to directly start trading and don't want to spend time and energy needed to write a trading plan, so they ignore it. This is one of the biggest mistakes a person will make because the lack of guidance from a trading plan will just lead to many more mistakes. Having a plan on paper will help you establish and keep to concrete rules while helping you avoid emotional decisions made when the market is heated up or when you are losing. People are irrational and can become horrible traders when they are under pressure and losing. If you have well defined rules, hopefully you will follow them and this will keep you on track. Finally, I want to say that you should keep reviewing your performance and plan. You cannot improve unless you learn from your mistakes. Reviewing is an important aspect of trading as it will help you to improvise continuously. This brings us to the close of first episode of our series on how to become a successful trader. The objective of this series is to create successful traders, and creating a business plan for trading, that is creating a trading plan, will be a very big first step in the right direction. So sit down and create a business plan today. You will definitely thank me later. In the forthcoming episodes of this series, we will talk about every single major and minor aspects of trading that will help you to become a successful trader. So subscribe to our YouTube channel right now to not to miss any of it. If you have any queries about creating a trading plan, please drop it in the comment section of this video. We'll be happy to answer it. If you want to encourage us, hit the like button, and if you find this video useful, share it with your friends so that they can be successful as well. Thanks for watching. Have a great day. Goodbye.